All right, so right now we're going to hear from two experts that are going to take us way outside of Miami, and they're going to share their knowledge of private and public funding for small businesses. They're going to help us explore trends seen across the country. First up, we're going to hear from Joel Combs, who is the Director of Impact Investment at Microsoft Treasury. Joel has been with Microsoft for over 22 years, and he has led the Treasury for the last 5. After that, we're going to hear from Joyce Klein of the Aspen Institute. Joyce is the Director of the Business Ownership Initiative, and that advances business ownership as an economic opportunity strategy. Joyce has been she's been working on this for more than 20 years, studying and supporting micro enterprises and entrepreneurial development across the country. She's also authored and co-authored numerous publications. So without further ado, I'll turn it over to Joel.
Thank you, Marta, and Access Helps for the opportunity to speak on this panel and with all of you today. As a way of background, just sort of echoing, I've been at Microsoft for my entire career for over 20 years and currently lead our impact investing initiatives at Microsoft, including our affordable housing investment efforts near our Redmond headquarters that we launched in January 2019 and our Global Climate Innovation Fund that we launched in January 2020. Last year, Microsoft also made broad commitments to take action to help address racial injustice and inequity. Today, I'll talk mostly about this third impact investing commitment. But first, I thought it would be helpful to sort of ground sort of the commonalities between all of our impact investing programs. At a high level, each of our impact investment initiatives are focused on and aligned with our mission as a company, which is to empower every person and every organization on the planet to achieve more. So Microsoft's impact investment initiatives focus first and foremost on the impact. We approach as an impact first investor while focusing on risk and lastly on return, where we expect a return of capital and a return on capital for the investments we make. So wanted just to differentiate that because beyond our impact investments, we also have a philanthropies team that focuses on grants and donations. At a high level, we have common sort of priority principles when we evaluate investments. And is often, I would say, more of an art than a science. First, it's really to create positive, quantifiable impact. So, for example, in affordable housing, it can be as simple as the number of units that we create, but it could also be as complex sort of as where those units are located, how many bedrooms. So it can get quite complicated in many layers between that. On the climate side, it could be tons of CO2 or gallons of water or tons of waste. On the racial equity investment space, we really look at, how much capital is provided into communities, jobs created, and those type of metrics. So the next sort of principle that we really strive for is to lead with diversity, equity, and inclusion in everything we do. So it's sort of embedded even within, when we think about climate or affordable housing, and especially racial equity investments. And then third, it's really how do we develop and utilize unique and innovative solutions while being catalytic, right? So how can Microsoft fill gaps uniquely based on our position as an impact first investor or a corporate investor? I mean, our goal isn't to displace existing capital sources, but really to enhance and expand them. Can we do something new or different that hasn't been done before? Can we attract new investors, nonprofits, governments to help close these gaps? The fourth sort of principle is, can we utilize public-private partnerships? Can we figure out ways to work with nonprofits or work with governments or work with national or sovereigns or other types of government entities? Can we somehow use the capital faster? So can we somehow make the capital available, get repaid sooner so that we can make more impact over time as well? And can we bring other capital sources together to help drive more impact in new and unique ways? And then lastly, but definitely not least, I would say is when we really center around data and the community voices. So really, how do we learn from others, leverage data, technology, really approach the issues and challenges of all of these initiatives with sort of an open and creative mind. It's really about, thinking about metrics, the tracking of the progress, using data to learn and make adjustments. And not to say that any of that is easy, but it's really trying to really continuously refocus. Now, I think it might be helpful to dive a bit deeper into our racial equity commitments in particular. Microsoft's approach combines, investments, technology, and intellectual capital to make meaningful progress to improve the lived experience at Microsoft, as well as driving systemic change across the United States. Microsoft's commitments, be they in the banking space, or financial commitments technology, philanthropy, or even our own hiring practices, they all really stem from sort of the same belief that the work we do as individuals and as an organization to address injustice and inequity is urgent and requires intention and sustained engagement. Within these broad sort of corporate commitments, though, my team is specifically focused on the banking pillar within our engaging our ecosystem commitment. So while this public commitment was new, these efforts are definitely not new for our team, is that we have been committed for more than 15 years to mission-driven banks, which includes CDFIs, or community development financial institutions, and minority-owned depository institutions, or MDIs. Microsoft has and continues to support mission-driven banks by making deposits to enable them to better serve their communities. So our commitment last year really took these efforts to the next level. Our approach has been to sort of take a look at the outcomes that are needed in the underserved communities, talk and engage with those in the industry and community, and then see how Microsoft can uniquely fit in. I mean, by all means, we're definitely not experts sort of in this field, but we really hope to leverage and share our learnings so that we can help others in their journey as well, and learn from them in their process too. Ideally, our investments will directly and indirectly help close racial equity gaps across a number of areas, including jobs, income, wealth, housing, healthcare. There's tons of other ones as well, but really like trying to be specific about what we're trying to address and how we think each investment in particular can address those, even if it has to be indirect. Given that we're looking at this from an investment perspective and not a grant or donation perspective, we really need to find opportunities with aligned partners where we think that there can be material downstream impact within the communities. We really recognize that stronger and more productive community requires diverse representation in those in all communities. Specifically relevant for today's discussion from a finance perspective is we are committed to increasing access to capital in local and underserved communities. We look for unique ways that Microsoft can utilize funds and partnerships to be catalytic. For example, Microsoft or any other organization can't address the urgent challenge of injustice and inequity alone. We hope that our efforts can really be a multiplier effect and be a catalyst for others to try new things. We're focused on strengthening the communities by using data technology, right? Sort of to reiterate that, like, how do we do that, pull that together, and really pull together diverse people across the US. The work we do is grounded in how we empower others to drive forward scalable solutions and efforts. So now getting into the specific investments, we really have, I would say, two different approaches. One is to strengthen and leverage mission-driven banks, and two is to invest in small businesses. So in the first, when we're searching for potential partners, we have been drawn to mission-driven banks, which serve rural, low-income, or minority communities at a much higher rate than traditional banks, making them really best positioned to serve these underbanked and underrepresented communities that we're really trying to drive the most impact in. Strengthening and supporting mission-driven banks is really key to our commitment to support the creation of an inclusive financial system, and thus we have focused much of our efforts here. These mission-driven banks provide capital to small business and individuals in the communities they serve. So in regard to strengthening mission-driven banks, I'll just sort of talk about a few of the different investments that we've made commitments or executed. The first was with the EBA Fund, who Joyce, who's next, I'm going to speak to you next, was involved in the creation and setup of this fund. I find that the EBA Fund was very innovative in then how it tries to increase the impact of mission-driven banks by buying their existing loans that they've made within their communities so that they can actually make additional loans in their communities. But I'll leave it to Joyce to add more comments there if she thinks it makes sense too. One thing I would point out is EBA does partner with CDFIs who work in Florida. So just to sort of tie it to the local aspect here. The second investment commitment was to the SOAR Fund, which provides additional capital for mission-driven banks to really loan more capital to small businesses and nonprofits with less than 50 employees in 15 southern and southeastern states, which represent more than 50% of the country's Black and African-American population. The vast majority of SOAR's loans are to diverse or women-owned small businesses, and they do this through key CDFI and MDI partners. In general, these loans would likely not have been provided by traditional banks because they're typically $100,000 or less, so they're too small for larger banks to make. It's sort of the scale that's needed. And to tie it locally, for you all, is that Axion and BBIF provide capital from the SOAR Fund to small business. So Axion is a global nonprofit that's really committed to creating a financially inclusive world and really focus in the microfinance and fintech impact investing. They really work to empower families, small businesses, and communities that are overlooked sort of by global financial systems. So you can see how they fit well within SOAR as well. And then BBIF is a leading non-traditional minority lending and financial coaching provider who really specializes in bridging the gap between small businesses and the money and education they need to reach their economic potential. So those are some great resources potentially locally, as well as through the SOAR Fund. Our third investment commitment in this area was, just recently announced with the FDIC and Truist to create the Mission-Driven Bank Fund. The goal of this is to be created fund is really to provide equity and other flexible capital to mission-driven banks to enable them to have a vastly greater impact within their communities. One reason that this is a great option is because it allows us to leverage what we've learned over the last few years, and that deposits were having less and less impact given that they needed the equity to help scale that. So this fund can help bridge that gap that's needed. And so sort of pivoting to sort of our second approach is investing in small businesses. We did this sort of through two different paths. And one was because we knew that we couldn't do this alone. We can't make a ton of small business loans. We just don't have the scale. And so we need to find partners. So the first was with Siebert Williams Shank to create the Clear Vision Impact Fund. So it's a fund that's led by a Black-owned and financial partner, like Siebert Williams Shank. And then they also drive to invest and have aligned impact goals. And so they've been a great partner in this. And it's been very, I would say, received well by the corporate community. And there's been a number of other large corporates who have invested in that fund. And then another investment that was recently announced in the last year was Morgan Stanley's Next Level Fund, which is focused primarily on early stage technology and technology-enabled companies. So really, it's such an underserved community within the venture cap space that we wanted to make sure that we supported that with some key partners. So just to sort of close in a couple key learnings is that investing directly into businesses, sort of as I said, is not something we did. So it's always about the partners and having aligned partnerships. That's so important to us. A big challenge that we've had is really, and we've seen a number of times, is really the connecting of underrepresented and underserved businesses with sources of capital and resources that may be available. I mean, it really seems fragmented and inconsistent, and we continue to look to opportunities with external partners on the potential, solutions that we could find here. And it is really great to sort of see how Axies Helps is doing this within your community, and we hope to see more of this across the country to help drive capital to small businesses. I mean, sort of in closing though, we're really hopeful that our efforts and the efforts of others will come forward, will help continue to drive impact in underserved and underbanked communities in the years to come and drive the changes that we all hope to see. So hopefully that was some helpful insight for all of you. Thank you.
Joel, thank you so much for sharing that information and sharing some insights and some of the new programs that you're all working on. We're going to turn it over to Joyce Klein. Just real quick though, I failed to mention earlier, you're noticing both of our speakers are speaking separately, but we will have a combined Q&A right at the end. So feel free to share your questions in the Q&A box throughout the presentation and throughout Joyce's presentation coming up. And we will definitely get to those questions shortly. Again, thank you, Joel, and Joyce, please take it away.
Thanks, Marta, and thanks to Access Help for inviting me to be part of today's event. I'm delighted to be here. And as you noted in your introduction, Marta, I direct the Business Ownership Initiative at the Aspen Institute. Our work is centered on expanding economic opportunity in the US through business ownership. And what that means is that we focus on the entrepreneurs or the aspiring entrepreneurs who have the greatest challenges accessing the resources they need to start and grow their businesses. And those are typically people of color, women, immigrants, and others. And our work really focuses on trying to figure out strategies, policies, practices, products that can meet the needs of those business owners. And in doing that work, we partner closely with community development financial institutions and with enterprise and micro-enterprise support organizations that work with these business owners. And one of the things we do is we pay a lot of attention to national trends in small business ownership and trends in small business capital markets, as well as what's happening, particularly in the CDFI industry, to help CDFIs really understand the changing context that's out there in the communities and how that might shape their work. And we also spend a lot of time working with CDFIs to help them identify what's working in their work so that they can become even stronger and do even more. So what I'm going to speak to today are some key trends and what they might mean for Miami. And in particular, for entrepreneurs, again, who are people of color, women, immigrants, and others who face significant challenges. The three trends I want to talk about are, first of all, what's happened and what is happening for small businesses because of the pandemic. What's happening and what's likely to happen in small business credit markets, and how what the pandemic has really reinforced in terms of what it takes to get capital and resources to entrepreneurs who face the greatest challenges, and what that tells us about what we should be doing going forward. And I'll try to connect that back to some of what I know about what that means in Miami and what you might do locally. So first of all, in terms of what's happening for small businesses, I think we all know that there was a huge shock to small businesses particularly when the pandemic first hit. A real shock to commerce generally, lots of closures. I think we all know from the reporting that the deepest impact was on small businesses owned by people of color. Blacks, Asians, and Latinos in particular saw really high rates of temporary business closures. There was also a really deep impact on certain sort of sectors and industries, in particular food, accommodations, entertainment, and storefront retail. What we've seen since the sort of spring and summer of last year is that we've seen a real recovery in the number of businesses that are operating. So many of the businesses that temporarily closed were able to reopen. That does not mean they're not still experiencing challenges in terms of revenues and other kinds of issues as the pandemic lingers. We're still seeing some significant challenges in some deeply affected sectors, again, like food, accommodations, entertainment. We've also seen what looks like a really big shift to online retail from storefront retail, and that may be a permanent shift that folks in the retail industry are going to have to deal with and confront. Another thing that's been really interesting is that we are now seeing an unprecedented level of new startups. So we typically see startups during a recession or an economic downturn, but there are two things happening that seem to be happening right now that are quite different. One is that the level of startups is much higher than, say, what we saw during 2008 in the Great Recession. So it's bigger in intensity. And the second is that there are indications that these aren't just people that, the folks who are starting businesses aren't just people who are becoming self-employed or who are doing gig work because they've lost their jobs. There also seems to be some startup activity, significant startup activity, in people starting firms that are actually likely to employ others. And it's happening, the numbers, there's some indications it seems to be really strong among Blacks and Latinos in particular, less so among Asians. And interestingly enough, in some of the sectors like food that have been pretty heavily affected by the pandemic. The last thing I would point out in terms of a national trend, that economic trend that's really important to think about, is that the real changes we're seeing in the labor market, which is that the pandemic, I think, really highlighted the long-standing issue we have with the low quality of many jobs in our country, in terms of wage levels, in terms of the extent to which jobs accommodate family obligations, in terms of workplace safety, in some cases worker voice. It's making it really hard to attract and retain workers in the current moment, and we are certainly hearing that small businesses are feeling that right now. So that's what we see in terms of what's happening in small businesses. In terms of small business credit markets, again, some interesting trends there too. First of all, just to be clear about the landscape, there's really three sets of players I'm going to talk about. One is banks, one is CDFIs, or mission-based lenders, and the third are non-bank lenders. This includes fintech lenders who have really emerged in the last decade or 15 years, but also other kinds of commercial finance providers like merchant cash advance firms or factoring firms, or that have been around actually longer than that. And again, if we go back to the beginning of the pandemic, I think many who look at small business credit markets expected that there would be a real sort of devastating impact, or a real challenging impact for financial institutions that lent to small businesses because of what was happening to the small businesses themselves. And the closures and declines in revenues would make it really hard for them to pay on the loans they had outstanding. And so there were a lot of concerns about the financial health of banks and CDFIs. Those institutions really increased their reserves. bank profitability and earnings were down. And in the non-bank lender space, we saw a lot of lenders really challenged because of rising delinquencies. Some of those lenders securitized their loans and there weren't purchasers for those loans. So a lot of challenges and a lot of churn in the non-bank space early on. And then what we saw is that as PPP and other sort of relief programs, including state and local and philanthropically funded relief programs came in, they made a real difference. They helped businesses to make payments on the loans they already had. And so we didn't see the kinds of delinquencies because people could use a PPP loan or an EIDL loan to cover payments, or because the SBA was covering payments on SBA supported loans. And we also saw that those programs, particularly PPP, but others as well, allowed financial institutions to keep lending. They got, typically they were lending out of these programs. They didn't have to carry those loans on their balance sheets. They generated fees and that helped their financials. And so, we didn't see the delinquencies and losses in loans that we expected. Although I will note that for non-bank lenders, the rates of delinquency were about twice what we saw at banks. And that's not that surprising because they tend to lend to somewhat riskier borrowers, but also sometimes they're underwriting. For some of those, I would say non-bank lenders, some of us could have predicted that would happen when there was a downturn in the economy. I would also note that one thing that's important is that there are some states that have seen much higher levels of delinquency in small business loans. Those are not surprisingly places that have been really deeply impacted by COVID, and Florida is among them, as well as Texas and California. But the other thing I would note coming out of that is that banks and CDFIs right now are actually quite strong financially from a balance sheet perspective, in part because they took all these reserves that they didn't end up needing, in part because there's been a lot of investment in CDFIs, and I can talk a little bit more about that later. But despite that, and from a banking perspective, we're really seeing banks in some ways pulling back in small business credit market, small business lending, which is not that surprising. We tend to see that in a recession and in an economic downturn. And we anticipate that will likely continue. And in terms of non-bank lenders, commercial lenders and CDFIs, I think they're working to be lending actively. One thing I would note is that going forward, I think the extent to which CDFIs and non-bank lenders are able to be lending is going to depend in part in their ability to access government programs or philanthropy that can provide them with greater protection from risk. Because given the state of the economy and the continuation of the pandemic, it's still a pretty uncertain environment for small business lenders. And it's hard for lenders to underwrite against the past year and a half of financials because of what's been happening to small businesses. So they're going to want protection from risk and going to need that in order to be lending. So what happens in terms of the state and federal level, in terms of small business programs that really support risk, and I can maybe talk about those in the Q&A section, will be really important. So a couple things I just want to point. We've learned a couple things. So that's what we see in small business credit markets. In terms of what we've learned about what it takes to serve the kinds of entrepreneurs that I think we're all focused on here today. One thing that I think we knew before that really became clear in the pandemic is that banks are not a great delivery system for reaching these businesses. And that's the case for a number of reasons. But I think one of them gets to something that I think Joel referenced as well, which is that lending to the most excluded business owners is not a very profitable business. So, and one of the things that I think has been increasingly clear is that the impact of systemic and structural racism and sexism means that the businesses that are owned by people of color and by women are generally smaller than those owned, particularly by white men. Their businesses have had fewer opportunities to grow, to access financing, so their revenues are lower, which means they need smaller loans. And small business loans of less than $50,000 or even less than $100,000 either aren't profitable or lose money. So banks don't typically want to make them, and CDFIs that want to make them tend to lose money on those transactions, so they need additional subsidy to be able to make lots of loans. And non-bank commercial lenders are sometimes in this space, but it's really important to note that often the prices and some of the other features that accompany their products because they're trying to make money, can be really problematic for small business owners. And so as we think about who steps in to meet the credit needs of small businesses, it's really important to think about how we're able to increase the supply of affordable and responsible capital. I think the final thing, so just quickly in terms of, you know, what we've learned about how to reach business owners of color and women and immigrants, I think having the right products is really important. Part of that is about offering smaller loans. And so I think we've been focused a lot on how to help, in particular, micro lenders and lenders that make loans of less than $100,000 grow. And that was one of the reasons we started the EBA fund, which I could talk about later if folks are interested in it. I think we need to think hard about how to get money to startups right now. We're seeing lots of startups, and a lot of lenders tend to do less lending to startups because they're harder to underwrite and there's more risk there. But I think that's a product we're going to have to focus on. Building trust is really important. People who have been turned down for credit multiple times, who haven't been able to access the financial system, people who come from other countries of origin, particularly ones where financial institutions don't serve them, or there are histories of corruption in financial institutions or systems or government, often have, you know, real concerns about how they interact with lenders who they don't know. So building trust is really important, and cultural competence is really important. And that's partly about being able to connect to folks in their languages that they're comfortable in, but also being really able to understand and acknowledge the experiences that they bring to business ownership and with the financial system. So just to wrap up quickly, I think some things that are really important to pay attention to as you think about how to build an ecosystem in Miami are just who are the organizations that you can bring into this that can build trust and have cultural competence to work with women, to work with immigrants, to work with business owners of color. And to really understand the experiences and the knowledge that they bring to this work, but also what they need to do to access formal financial systems. I think really important to think about how some of these trends we're seeing at the national level, trends in key sectors, trends in startups, trends in delinquency may affect what's happening in terms of small businesses and small business credit markets in your community. And one thing I would note that gets to some of the work that's being done to really help business owners understand where they might go for credit or for other kinds of assistance. I think as you build a local ecosystem, it's really helpful and important to be able to help business owners understand in detail the products and services that these organizations offer, like what size of loans, what stage of businesses are they good at supporting? What kinds of communities have they, really figured out how to serve well? Whether that is particular ethnic and racial communities, or women, or early stage businesses. Business owners are really busy. They don't have a lot of time. They need to find quickly the resource that works well for them. And often if they can't find that resource quickly, they will turn to other sources of capital that may be much higher cost and more problematic, because those will often get them an answer to whether they can get a loan fairly quickly with minimal documentation. So there is this real trade-off between the work that it takes to build trust and understand the borrower, but also the speed with which and the ease with which organizations need to interact with small businesses, because they are so busy and are so strained at this time. So with that, I'm gonna stop and look forward to the conversation.
Joyce, that was wonderful. Thank you so much. All right, so we have one question that is the same question for each of you. And then we have a few additional questions that are sort of flowing in from the audience. So what is, if you had to encapsulate, from your experience, from your perspective, if you had to give us one call to action, what would that top call to action be for Miami-Dade County?
I mean, I can quickly start. It's a consistent theme throughout everything. And sort of, as I mentioned earlier, that it's not something that any one person or organization or company can do. And it really needs to be everybody working together and bringing awareness and bringing together clarity and, you know, visibility and talking about it. And I think it's sort of what's first and foremost needed. One
thing I would say, I'm not sure it's the only call to action. One thing that I think will be important is to, because there's many things that need to happen. I think it's going to be important for folks locally to cue into what's happening at the state and federal level in terms of some critical pieces of policy and legislation. So one that I would flag is the State Small Business Credit Initiative. This is a federal program that gives money to states to help them, basically provides different kinds of credit enhancements to try to ensure that lenders can be lending in a context like this. It was reauthorized as part of the American Rescue Plan Act. The Treasury is working on the guidance for that, and states are going to stand it up quickly. And that money will start flowing to states. I think early, at the beginning of next year. There's a real interest in making sure that the program, which came into being after the last recession, really targets the most underserved entrepreneurs. So there's an opportunity to do things that could really support CDFIs and other institutions and to support the kinds of small dollar lending that are really important, but cueing into what's happening at the state level and making sure it's working for local institutions, I think could be really important. The other thing I would say is there are two other things that are happening at the federal level. One is that we actually don't have great data on commercial bank lending to small business owners of color because banks aren't required to report who they're making loans to the way they are under mortgage loans. And there's new legislation, it's called Section 1071 of Dodd-Frank, that's going to require banks and other small business lenders to report that kind of data. The Consumer Financial Protection Bureau just is charged with implementing that. They're just in the process of rulemaking and asking for comments on their rules. There's some really important stuff happening there. I can talk about that more later, but that's going to be really important because it's going to change the context, it's going to change the data. It's going to help us really understand who's getting access. And we think it's a way to figure out not only who's getting access, but what kinds of products people are getting access to. Because I think one thing we need to balance is that you want people to get access to capital, but you want them to get access to capital that helps them to build their business, not undermine their business. And the third thing is that we know that I think several members of Congress who last year introduced a Small Business Truth in Lending Act are about to reintroduce that again. And that could also be a game changer in helping small businesses really understand the costs of financing that they may be taking on, which right now lenders aren't required to disclose.
Thank you for both of you for sharing that. We do have a couple of questions and we have a few minutes to answer them. I'm going to start with the first question, and I think that this could equally be answered by either and maybe hopefully by both of you. The question is, we hear often that minority businesses, Black, women-owned, all different types of business loans, those types of loans are less profitable to process. However, we're also hearing about promising loan repayment and default rates from marginalized businesses. So it's kind of this thing that's happening. How much of this is true that loans are not profitable and risky versus the misperception that due to factors like that are related to something larger like systemic racism?
At a high level, I would say I'm not nearly as qualified as Joyce to answer this question. She's going to be much more knowledgeable here. I just think it's important to highlight that the data and getting that data and that clarity and the visibility and creating transparency in all of this is where you can start making large changes. Because I don't know necessarily what the answers are, but getting more and more data is what's really going to be key to hopefully unlocking the potential within all of these communities.
Here's what I would say. I would say that these loans are less profitable. When I talk about very small business loans being generally less profitable, it is not because of largely, it's not because of higher risk. It's because the costs of getting the information that you need, finding the customers and getting the information you need to underwrite the loan, process the loan, service the loan is lower than the cost of action, is lower than what you get from interest and fees if you have generally an affordably priced loan. So you just on a small loan that's a year long, that's at a 9 or 8% interest rate with monthly payments, there's just not very much money there. And it just doesn't cover the costs of lenders who are really, underwriting responsibly. And I will say that's true. The biggest cost for any small business lender is not risk, it's what they call customer acquisition. So that's the first thing I would say. The second thing I would say is, I do think that one of the ways that CDFIs have increased their lending to particularly the business owners of color who are low wealth because of systemic and structural racism is by making what are called unsecured loans. So they're not requiring collateral or people to put in wealth that they don't have because of systemic racism to make that loan. Generally speaking, unsecured loans are higher risk than secured loans. So you see very low default rates and mortgages relative to credit cards. One is an unsecured product, one is a secured product. It's not because the business owner is Black or brown or a woman as opposed to a man. It's because of unsecured lending is just generally riskier, but unsecured lending is a product that's more accessible because it doesn't require the business owner to have wealth.
So if there's a follow-up to that question or please jump into the Q&A. I do have another question for you, and this is for both of you really. This is also a little bit circumstantial. So in your opinions, do you think that philanthropic dollars would go further by de-risking capital, so loan loss reserve funds and credit enhancements, or is the process of provisioning direct grants or or forgivable loans to small businesses the way to get those dollars to stretch further?
I don't think that there is a right answer to this. I think they both have their time and place. So I'm not going to answer your question directly, but in general, I think it's when you do the credit enhancement or the loan loss reserves, or it provides the unlocking of additional capital that might not have been available otherwise, so you can get that catalytic nature. And so I think the EBA fund is a great example that Joyce was a critical part of creating, that we invested in. So I think that is one where there's a lot of money that it could be unlocked, where with the direct grants or funding to businesses is extremely impactful and sometimes necessary too, but it might not be able to pull additional capital from other providers such as Microsoft alongside of it. It might, because then it's going to be a one-off process in different ways. So they both have a time and a place, and I think they're critical. And I think that every organization should do what they feel comfortable with. And how do you partner together to do things in new ways?
I would agree. So here's what I would say. I would say loss reserves and credit enhancements, yes, you will get more leverage. As an investor, you will get more leverage because that's the way that's structured. But I will also say that if we don't find ways to get small dollar loans and grants particularly to business owners of color, you're just not going to reach enough because the CDFIs can't do the lending if they don't have money to cover their operating costs. And that typically takes grants. I will note, part of what we're trying to do with the EBA fund that Joel referenced is that we found that banks that want to acquire the loans that we purchase from CDFIs to help them do better against their CRA rating are willing to pay a premium for those loans. So they're paying more than their face value. And what we do is we send that premium back to the CDFI to help them cover the cost of more loans. So we're using leverage to make that work, but the real value of that is it actually in generating another source of subsidy to help CDFIs be able to make more small dollar loans because the economics are just a challenge.
Okay, all right. Thank you again. So 2 more questions. I think we have time for 2 more questions. Joel, the first one is for you. I think there's a combined question of where do you see Microsoft headed in the next few years? And there's a little bit of curiosity about the new program that you mentioned with Truist. And so if you could give us a little bit of, if folks want to hear a little bit more about where you're headed.
Yeah. Impact investing is a relatively new thing for Microsoft. And so I'll focus specifically within that area. And, we're still building that muscle and growing that skill. So, starting with affordable housing, then climate and racial equity. Those are all big, sort of nearly impossible things to try and solve. But trying to think and get smart about that, I think, is critical. So not exactly sure where we'll go. We haven't solved any of those yet. So we still have a long ways, I would say, to go on all of those. And sort of the second question in terms of what I see with Truist and the FDIC. So that fund is still getting off the ground and getting up and running. But the goal of that fund is really to provide capital to CDFIs and MDIs, or mission-driven banks, however you want to characterize them, to really provide them the capital that they need that can be differentiated. So every MDI and CDFI may have different needs in terms of the capital. So they might need equity to help scale their technology or their business, or they might need equity to go hire some more people so they can go make more loans, or maybe they need loan loss, protection or loss sharing or other things. So it's providing them the capital that they really need. And there's been quite a bit of commentary recently from FDIC Chairwoman McWilliams sort of on this fund. And I mean, this was in our initial announcement in June of last year. So working together with the FDIC and partnering with Truist to sort of get this fund process moving, where we're now going to be actively trying to reach out and select jointly a fund manager who will lead this initiative to go provide this capital to mission-driven banks.
Thank you. Okay, that's great information. And Joyce, last question, you'll close this out. This one is pretty specific around microloans. The general question is that they're very popular, particularly and they're quite successful in other countries. Why do you think that they aren't as popular or available in the US when they're known to work elsewhere? So kind of a very...
I think it's less a question of popularity. I think there are a number of reasons why we don't see as much of it in the US as we see in what I would call sort of more emerging economies. Part of it is there are a lot more sort of micro businesses, self-employed people in sort of less developed economies than there are in the US. So, when you go to some places and like 50% of their workforce is, a small business owner or a small scale entrepreneur, where here it's about like 8 or 9% of our workforce that does that. So you're just going to see fewer of them. They're actually harder to find in some cases. So it costs more money. Like this economics problem is a big problem of like what it actually takes to grow this kind of lending. And the fact that it needs some subsidy to do it well, it's actually harder to find business owners here because they don't all go to the market, or you don't have cities where you have large numbers of really small scale retailers. People tend to be a little more hidden. They do a lot of stuff out of their house. They're actually just from like a marketing perspective, it's harder to serve them. We also pay people a lot more in the US. So it's actually costs, like the labor costs of running an organization like this are actually in some cases significantly higher. So there's a number of different reasons why it's a different scale here. But I would say one of the things we know from like Federal Reserve data is like, I think it's 71, I'm not trying to remember, 71, 74% of Black business owners are looking for small business loans of less than $75,000. So it's not, the numbers are not quite as high for Latinos, but they're high for women as well. Like there's a lot of demand in the small dollar credit market. For businesses, we just have to figure out how to make it work better.
Got it. Okay, that's great information to know. Joel and Joyce, thank you so much for joining us this morning or afternoon, depending on where you are. This has been a great conversation.